Hello, my name is Andrew Hers, and I'm going to be discussing the major strategic alternatives and the decision criteria for the Gainesboro dividend policy question. Major strategic alternatives. There are four major strategic alternatives that have been identified as possible dividend policies to pursue going forward. They include a zero dividend payout, a 40% dividend payout, a 20% dividend payout, or a residual dividend payout. All four possibilities have pros and cons, which will be examined in detail on the next slide. For the zero dividend payout, there are several benefits. Gainesboro has been shifting its focus from industrial machinery to more high-tech endeavors over the past several years, making large investments in computer-aided design and computer-aided manufacturing. Moving to a zero dividend payout would position the company for high growth and would be more consistent with the dividend policies of its competitors in high-tech fields, which Gainesboro expects to be compared to more often in the future. A zero dividend policy also allows Gainesboro to retain more of its cash to address the financial difficulties that had really befallen it in the early 2000s. There are issues with the zero dividend policy, however. One is the will of the shareholders. Though the percentage of the shareholders who hold stock for the long-term or retirement purposes has fallen over the last 10 years from 37% to 26%, that's still a large percentage who expect less risk and reliable dividends. In addition, the board of directors has already declared their intention to pay dividends in the future to the shareholders, and going to a zero dividend payout may make investors feel misled or even betrayed. On the next slide, we'll look at the 40% dividend payout option. Announcing a 40% dividend payout would signal to the market that Gainesboro is back on the right track, and it may lead to an increase in buying and share price, essentially paying for itself. Even if the company had to borrow in the short term to pay out the dividend, many managers argue that such practice is consistent with other firms in the industry. At its core, a 40% dividend payout would give investors what they are expecting from Gainesboro, a high dividend and the impression that the company is safe and reliable. Facilitating this impression of strength may come at a cost to the firm, however. There's no guarantee that paying such a high dividend would indeed lead to a spark of confidence among investors, and if sales and share price remain status quo at 40%, the dividend may prove to be unsustainable. It also sends a mixed message with the company moving into emerging technology while simultaneously paying dividends out comparable to a blue-chip industrial machinery firm. On the next slide, we'll discuss the 20% dividend payout option. At first glance, the 20% dividend may be the best of both worlds. Gainesboro would continue to pay out a dividend to keep 26% of its shareholders interested in long-term holdings happy, yet it also shields itself from the possibility that sales and share price remain stable after news of the new dividend policy is released, keeping its debt-to-equity ratio at a manageable level. On the other hand, if Gainesboro moves forward with this dividend policy, that may end up pleasing no one in their effort to please everyone. Those who are holding the stock for a long-term investment may see the move as a hedged bet and move their funds elsewhere seeking a more reliable and stable dividend payment. Those who hold the stock for growth may see the 20% dividend as a sign that management is not fully prepared to reposition the company as a high-tech firm and choose to invest in more established high-tech firms that fit their needs and investment goals. On the next slide, we'll look at the pros and cons of the residual dividend payout. Members of Gainesboro's finance department have proposed residual dividend payout models whereby the payouts would only occur after positive net present value projects have been fully funded. They believe investors will appreciate that Gainesboro is using funds that would otherwise be paid out in a dividend to fund projects that would increase the value of the company beyond the value of the dividend. This higher company valuation would in turn lead to a higher share price. The downside to the residual dividend proposal is that it is yet another half measure similar to the 20% dividend proposal. The firm runs the risk of alienating all of its investors in smaller ways rather than confidently going with one strategy. Another downside is that the dividend payout model would be unpredictable under a residual payout method. Some years the dividend might end up being zero, upsetting some long-term investors. Some years it would be higher, but perhaps not high enough to satisfy all parties involved. Implementing a residual payout could also lead to conflicts among upper management, with project managers pushing for more funding for projects while executives who are more sensitive to shareholder desires may fight to keep a more reasonable dividend funded. On the next slide, we'll look at the decision criteria we're using to make our final recommendation. There will be three main criteria that we consider when evaluating the alternatives to be considered for Gainesboro's dividend payout policy. The first two criteria will be to keep our policy in line with major corporate goals, which are to maintain a growth rate of 15% and to keep the firm's debt-to-equity ratio below 40%. The third will be to reconcile these economic realities with the will of the shareholders. The first goal outlined by Gainesboro's management team was that the firm should have an average annual growth rate of 15% compounded yearly. Major strategic initiatives have been devoted to this goal, including the restructuring of the firm so that CAD and CAM and other high-tech products would account for over 3/4 of the firm's total sales. The acquisition of small software companies and aggressive international expansion plans round out this new strategy. The company wants to be able to achieve these goals with as little debt as possible, with a 40% debt-to-equity ratio being set as the highest allowable by co-founder David Scarborough. Any dividend policy must be made with these goals in mind. Any policy changes must also be made with the will of the shareholders in mind. Over the last 10 years, the demographics of the firm's shareholders have changed. 37% of shareholders used to hold stock in the company for long-term purposes, but that number has fallen to 26%. Short-term holders and undefined investors have grown in proportion and signals that the demographics of Gainesboro shareholders may be shifting, possibly in response to their growth strategies and strategic repositioning. Now Lauren will discuss the next two portions of our project. Thank you very much.